Monday, April 10th, 2017, Monaco 64, home of alternative economics and contrarian views. So huge story out today on the BBC, and the headline is Libor, Bank of England implicated in secret recording. So first of all, I want to give you some background on what Libor is. I've got 20 plus years experience in the financial markets. I worked as a futures and options broker in London. I dealt for major banking institutions, fund managers, mutual funds in Europe, the US, throughout the world. And so I know what this is about. Basically, Libor stands for London Interbank Offered Rate. There's also Libid, which is the London Interbank Bid Rate, bid and offer. So Libor is the rate at which banks have to pay to borrow from other banks in London. And why in London? Well, because London was and still is the center of the euro dollar. And the euro dollar's got nothing to do with the euro. The euro dollar are basically dollars that are outside the United States. They've been out the US since the 1960s, and they're traded in the London market. And so if JP Morgan wants to borrow 3-month dollar in London, they'll call, for example, Citibank and say, what's your Libor, 3-month Libor for dollars? And they'll say 3.5%. Okay, I'll borrow that for 3 months. Or if an Italian corporation wants to borrow some dollars, they'll call JP Morgan in London. Or if a German automaker needs to borrow dollars, they'll call Deutsche Bank in London and ask for the London Interbank Offered Rate in US dollars. And that rate is really important. It's the benchmark for borrowing money in dollars. And as the dollar is the reserve currency of the world, it's really a big deal. So what happened in 2008? Well, I was working in the markets at the time, and there's a future, interest rate future called the Eurodollar future. And it's based on the Libor, 3-month Libor. And the way it works is if the rate is 5%, for example, the future will trade at 95, which means 100 minus 5, 95. So if the future was at 100, that means rates would be at 0. So what happened during 2008 financial crisis? Well, banks in London and elsewhere, particularly in London though, because this is a London-based market, they didn't trust each other, especially after what happened to Lehman. So all these, the Libor rates, they spiked completely. They went through the roof, and no one wanted to deal with each other. And I remember that because the markets went crazy. This future that I was trading, went up in value because the rates went up. Sorry, the futures traded down in value. Let's say they were trading around 96, and all of a sudden they're going down to like 92, 93. I even remember it went down to like 93. But then all of a sudden, the market was stabilized, central banks intervened, and those rates just like went back down. And so what's this all about? Well, if you remember 5 years ago, there was a huge case about how the banks rigged the Libor rate, that it wasn't a real rate. But now it's coming out as well that the Bank of England was implicated. So I'll read a little bit here from this BBC News.co.uk story. And I'll quote the story. It says, a secret recording that implicates the Bank of England in Libor rigging has been uncovered by BBC Panorama. That's a BBC TV program. It's a bit like 60 Minutes, I would say. And it says, the 2008 recording adds to evidence that the central bank repeatedly pressured commercial banks during the financial crisis to push their LIBOR rates down. So basically, let's say the LIBOR rate spiked from 4% to 7%. A central bank, Bank of England, supposedly came out and said you have to say that rate is actually 3%. You have to lie about it. So this is what this story is about. The Bank of England was trying to portray the market as being something different, than the reality. So I continue here. LIBOR is the rate at which banks lend to each other, setting a benchmark for mortgages and loans for ordinary customers all around the world. There's also LIBOR rates for sterling, for euro, for Japanese yen, but the dollar rate is the most important one. And it says, the Bank of England said LIBOR was not regulated in the UK at the time. It doesn't matter if it was regulated or not. Fraud is fraud. It doesn't matter if the market's regulated or not. Anyways, it says the recording calls into question evidence given in 2012 to the Treasury Select Committee by former Barclays Bank boss Bob Diamond and Paul Tucker, the men who went on to become the deputy governor of the Bank of England. So what is the Treasury Select Committee? Well, that's the committee in the House of Parliament in the UK. So they testified, to Parliament about this in 2012. And it goes on to say, LIBOR, the London Interbank Offered Rate, tracks how much it costs banks to borrow money from each other. As such, it is a big influence on the cost of mortgages and other loans. Banks settling artificially low LIBOR rates is called lowballing. And it says in the recording, a senior Barclays manager, Mark Dearlove, instructs LIBOR submitter. The submitter is basically the trader who, picks the phone up and someone says, "What's your 3-month LIBOR rate?" And he tells them. And there's also a LIBOR fixed. I think it's around 11:30 in the morning in London, or 10:30. I'm not sure exactly. These guys give their rates and they can make a fixing for 3-month LIBOR every day. And it says, he tells them, that's the senior Barclays manager talking to the LIBOR submitter. And he tells them, and I quote, "The bottom line is you're going to absolutely hate this, but we've had some very serious pressure from the UK government and the Bank of England about pushing our LIBORs lower." So basically, this guy is saying the government and the UK government and the Bank of England are pressuring, commercial banks to lie about their rates, right? Push it lower to a rate that doesn't exist, just to try to pretend that things are okay. And it goes on to say, Mr. Johnson objects, saying that this would mean breaking the rules for setting LIBOR, which required him to put in rates based only on the cost of borrowing cash. Mr. Johnson says, "So I'll push them below a realistic level of where I think I can get money?" And his boss replies, Mr. Dearlove, "The fact of the matter is we've got the Bank of England, all sorts of people involved in the whole thing. And I am as reluctant as you are. These guys have just turned around and said, just do it, even though it's totally fraudulent and against the rules." Goes on to say, Mr. Dearlove declined to answer questions for BBC Panorama. Until recently, a member of staff at each of the biggest banks, the LIBOR submitter, would say that what interest rates they thought the bank would have to pay to borrow money. An average would be taken to arrive at LIBOR. Banks have been fined more than £6 billion for allowing submitters to be influenced by requests from traders or bosses to take into account the bank's commercial interests, such as trading positions. And it goes on to say, the phone call between Mr. Dearlove and Mr. Johnson took place on 29 October 2008, the same day that Mr. Tucker, who was at the time an executive director of the Bank of England, phoned Barclays boss Mr. Diamond. Barclays LIBOR rate was discussed. Mr. Diamond and Mr. Tucker were called to give evidence before the Treasury Select Committee in 2012. Both said that they had only recently become aware of lowballing. This was in 2012, and in 2008, it looks like they were pressuring these two guys, Diamond and Tucker. It looks like they were pressuring, these submitters at Barclays to lowball, and they're telling Parliament that they weren't aware of it. Panorama played the October 2000 recording to Chris Phillip, MP, who sits on the Treasury Committee. He told the program, "It sounds to me like those people giving evidence, particularly Bob Diamond and Paul Tucker, were misleading Parliament. That is a contempt of Parliament. It's a very serious matter, and I think we need to urgently summon these individuals back before Parliament to explain why it is they appear to have misled MPs. It's extremely serious." Well, there's more to this article, and I'll put the link below in the description. But what am I trying to get here as well? Well, the Bank of England, they're the major regulator of the LBMA, which is the London Bullion Market Association, which runs the bullion, regulates the bullion banks in London. So if they can manipulate banks to fake interest rates, why can't they manipulate banks to fake gold prices? To all those people out there who say there is no manipulation in the gold market or silver market, you just have to. I'm sorry. This is proof that it's not so. They are manipulated. And I went into the LBMA website and I've read the regulation supervision part of the LBMA, and it says the LBMA has no regulatory responsibility for the bullion market. This had traditionally been the responsibility of the Bank of England and more recently the Financial Services Authority. And it goes on to say, however, the recent financial crisis triggered major regulatory changes which came into effect on April 1st, 2013. And it says the Financial Services Act of 2012 established an independent financial policy committee, the Prudential Regulation Authority, as a subsidiary of the bank, meaning Bank of England, as well as new responsibilities for supervision of financial markets and market infrastructure providers. It says the PRA is responsible for supervision of banks, including bullion banks, building societies, credit unions, insurers, and major investment firms. And it goes on to say the FCA, which is like the SEC of the UK, which was established out of the Financial Services Authority, is separate from the bank. So what you can see here is really convoluted, but basically it's the Bank of England who's in charge of the bullion trading in London, and it's not regulated by the FCA at all. So an institution that did, I'm not saying they did it, but it looks very, because I can't, state it, maybe until there is a court case against this Panorama program is really brought out this, this tape, and it looks like they could be guilty of, the Bank of England and also the government, because it says individuals in the government, high up in the government, pressured Barclays Bank to basically fake their LIBOR rates. So if they can do that for LIBOR rates, why can't they do that for gold? And I think it will be very interesting to see what happens going forward. And the other interesting thing is that the LBMA, one of the, let's see here. Yeah, the chairman of the board of the LBMA is someone called Dr. Paul Fisher. And I'm not saying he was involved in the LIBOR scheme or anything, but he worked for the Bank of England. He was a senior figure for the Bank of England for 26 years. So you got this, the same people in the Bank of England who supposedly told the banks to rig Libor. They're running the LBMA as well. So I thought this would be an interesting story. And if you enjoyed it, please give me a thumbs up, share it far and wide, subscribe to my channel if you haven't yet. If you'd like to donate to my channel, there's some links below in the description, and I'll talk to you later. Take care. Bye.